starting this now. Yeah, thank you so much, George. We're very happy to have this topic today. I'm very excited for everything that you have prepared, and feel free to take it away.
Sure. Yeah, thanks for having me. Excited to be here with Newman again. So yeah, today's topic, like you said, is something that's only becoming more and more relevant, how to form a business from abroad. I think in our post-COVID world, it's something that is only growing exponentially now that people have figured out how they can basically work and provide services or engage in commerce from anywhere in the world. So this is a topic if you're either a US citizen living abroad or you're somebody who's not a US citizen but is doing business either in the US or transacting with US dollars digitally. It's something that's relevant for you. And there's a lot of advantages to forming a US entity. So hoping we can provide a general overview of just kind of an insider's overview of what it is, how to start a business and the advantages and what you can do to get one going and engage in one. Here's kind of an overview of what we'll discuss. There's three basic types of business entities, so I'll go over the basics of those. The basics of USA international taxation and business entities, how they're taxed, and then the advantages and disadvantages of US businesses, and then how to actually set one up and operate one in the US and stay compliant, which is obviously very important because there can be some serious penalties if you don't. So we'll go over those definitely. So the three types of business entities in the US, corporations, I'm sure everybody's heard of that. The taxation of a corporation is recognized as it's a separate tax entity. It files its own tax return, the Form 1120. And then so it's taxed at the corporate level, and then also shareholders are taxed on their dividends. So the disadvantage with the corporation is that it's subject to double taxation. So usually digital nomads, freelancers aren't structured this way. This is more of an advanced structure for companies that are seeking capital. That's something that's not commonly used by freelancers. The advantages of a corporation: liability. Shareholders have very limited liability. It's a separate legal entity. Shareholders can't be sued or aren't obligated for the debts of the corporation. And then formation of a corporation. It's a lot more complex to create than the other two entities. They have more legal and accounting requirements. So it's usually a little bit more expensive to form as well. And then the next level is a partnership. That's essentially any two individuals who are engaged in a for-profit endeavor is a partnership in the US. That's the general definition. It's taxed as a pass-through entity, meaning that it doesn't itself pay taxes. It reports its revenue and expenses and then passes that net profit to the owners at the individual level, and then the owners are individually responsible for paying the taxes of the partnership. For liability reasons, partnerships are less safe than corporations and LLCs. They typically have unlimited personal liability, meaning you can be held liable for the debts of the corporation. And sometimes in some cases, you can even be held liable for the other partner's debts. So a little riskier there. Typically not recommended for digital nomads and freelancers. But the one advantage of partnership is it's really easy to form. You just establish a partnership agreement, and in some states you don't even have to actually file with the Secretary of States. You just establish the agreement, and then it's a de facto partnership. And then the last entity is the LLC. This is a hybrid entity. It has the advantages as far as liability of a corporation, but the simplicity of a partnership. So this is by far the most common entity used by digital nomads and freelancers across the globe. It's taxed as a disregarded entity, meaning that the IRS doesn't even recognize LLC's existence. They once you form an LLC, you have to choose what structure you want to be taxed as. It's part of the formation process. You can either choose between a C Corp, S Corp, which isn't available to non-US citizens, so it might not be applicable to some of you, a partnership, or even a sole proprietorship. So it's very flexible as far as its taxation. The liability is more like a corporation as far as your personal liability. The shareholders can't be held liable for the lawsuits or debts or anything of an LLC, so that it's relatively safe in that regard. And then the formation, you do have to pay a filing fee in every state that you form it in. The lowest states are usually around 100 to 150, and the higher ones, like in California, it's actually $800 to form a LLC. And you have to have articles of organization, just like a corporation. So a little more complex, but not quite as complex as a corporation to form. So those are the three options you have. Like I said, LLC is by far the best option for smaller digital nomad type people that want to take advantage of having a US entity. So the basics of taxation for foreign owned US entities, I'll go over that. And a lot of people, when I talk to them, because we're getting a huge influx, because this is growing in popularity so quickly, we're getting a huge influx of people outside of the US that are wanting to form US entities, and they don't understand the taxation at all. So they think that it's based on the source of revenue, what you pay taxes, and it's actually not. It's based on where you're actually producing either the goods or services. The IRS calls it engaged in a trade or business. So you're generally only taxed on the USA portion of your earnings from being engaged in a trade or business. So what does that mean? This is the IRS's definition. One, you have at least one dependent agent in the US, which are employees or companies that work for you almost exclusively, such as like an independent contractor, anybody that's in the US boundaries. And the dependent agent does something substantial to further your business in the US, as opposed to something purely administrative, meaning they're actually performing services or doing something substantial, which is pretty general definition, but that's the IRS tax law. That's how they rate tax law. So you just have to kind of go by the guidelines. And then the third, or you are engaged in considerable, continuous, and regular business in the USA, meaning like that kind of clauses for is, say have a business and you're not at all in the United States, but you come into the US for like a trade show or something and you generate revenue, that wouldn't be considered considerable, continuous, or regular business in the US. So that wouldn't be considered, the revenue wouldn't be considered taxable. So that's where that applies. So as long as you keep your operations outside of the US, generally you're not responsible for paying US taxes. And then another component that applies to all entities, whether it be corporations, LLCs, or partnership, is international tax treaties with the USA. The vast majority of countries have tax treaties with the USA, and they generally they're all pretty similar. And the general intent is to avoid double taxation, meaning if you're paying revenue on or if you're paying taxes on revenue and earnings in one country, you won't be double taxed in the other country. And then it's to establish the way you allocate those rules in those two countries. And it can get very complex. For smaller operations like freelancers, it's not as complex, but when you involve like multinational corporations, it can get pretty complex. So that's the basics for US business entities. And how that applies to you, I'll just go over in general what is considered, if you have a US business entity, what's considered taxable and what's not based on what you're doing. So in general, it's not taxable if you're performing personal services from abroad, but the US entity is collecting revenues. It's not taxable if you're selling digital products from abroad, meaning if you're like developing an app or something and generating revenue on that, but you're not doing it, developing that within the US boundaries, it's generally not taxable. Like web design from abroad, IT development from abroad, not taxable. Creative services, I know that's a big base of the Numina membership. So creative services, if you're doing that from abroad, generally it's not taxable, even if you're generating revenue from the US. Or if you're selling physical products, like you're selling on Shopify or Etsy or one of those platforms. And if you're shipping from outside of the USA, it's not taxable, even though you're shipping into and you're generating US dollar revenue. It's generally not taxable. And then in general, taxable activities are selling physical products, shipping from within the USA. So say you're an Amazon drop shipper, you're shipping from a point in the US to another point in the US, that's typically taxable in the US, even though you're not the owners aren't US citizens. So keep that in mind. That's a pretty common scenario. And then any of the above services performed, web design, IT, all that, if you're doing that within the US boundaries, that would be taxable. So I put this section in because I get a lot of questions for people who are digital nomads that don't have business entities. And so I'll just go over the general guidelines just to give you an idea of how that works for individuals that aren't US citizens, but are generating revenue from US sources. So if you're what the IRS calls a non-resident alien, defined is an alien is an individual who is not a US citizen or US national. So basically anybody who's not a US citizen, the rest of the globe, the rest of the world. And then non-resident alien is an alien who has not passed the green card test or the substantial present test, meaning the green card, you have to have a green card, or the substantial presence test meaning you're in the US for more than 183 days. And there's a little more complex than that, but that's the general rule. So if you fall into that category, then you're considered a non-resident alien. And the taxation of non-resident aliens. And if you're engaged in trade or business in the United States, you must pay tax on the US amount of your effectively connected income after allowable deductions at the same rate that applies to US tax citizens. So you take your revenue that you earned in the US and you have to do an allocation of the deductions, which can get somewhat complex, and then you come to, excuse me, you come to your taxable income, and that's what you have to pay on taxes in the US. And then effectively connected income, when a foreign person engages in a US trade or business in the United States, all income from sources within the United States connected with the conduct of that trade or business is considered effectively connected income. So the definition again is somewhat broad. But essentially, if you're a foreign person and you're generating revenue in the US, you could be subject to this could apply to you. And then you get in, again, you have to look at the tax treaty between the country you're in and the US, and look at the allocation rules. And then this applies whether there is any connection between the US income and the trade or business being carried on in the United States during the tax year. So yeah, if individuals, this shows that individuals are taxed differently from corporations. And this is where it can benefit you. If you're not a US citizen doing business in generating revenue in the United States, you're taxed differently if you're an individual versus a corporation or a LLC or a partnership. And you are subject to a broader range of taxation rules, meaning the US can collect taxes on you a lot easier as an individual, as a corporation. That's the big advantage of forming a corporation. There, the laws related to that are a lot tighter and harder to tax in that situation if you're doing business with a separate business entity. And like I said, US tax treaties, the intent is to avoid double taxation. So even individuals, usually if you're taxed in the US, sometimes you can get a credit for taxes paid to foreign jurisdictions. But it again varies with each country and gets somewhat complex. So each individual scenario is a lot different. So keep that in mind. So now I'll just go over the kind of advantages and disadvantages of each entity. So LLCs, like I said, by far the most common for freelancers and digital nomads. They're known worldwide, globally, for e-commerce, payment processing, and service businesses such as like consultants and IT developers. This is by far the most common entity. So this is what I recommend for the vast majority of people watching this. It's like I said, a minimal cost to open. Legal fees vary from anywhere from $200 to $800. And a lot of people, when they come to us, they question, they don't know what state to form in, because if you're not in an actual United States and you're not in a state, you can form in any state you want to. So and each state has different fees and different laws. So generally the most advantageous states are Wyoming, Nevada, and New Mexico for LLCs. And that's usually because you can maintain anonymity of ownership in those states, and the fees are a lot smaller. I think Nevada is about $300 or $400. Wyoming's only $150, and New Mexico, you pay an initial fee and then there is no annual fee. So that's why New Mexico is becoming more and more popular, especially for smaller operations. And then the advantage, if you're looking to form a corporation, if you're outside of the US and you're trying to form a startup that's eventually going to gain or attract outside capital investors, a corporation may be the route you want to go. And another advantage is you can operate in the US and pay a management fee to your foreign owners and operators who are operating outside the US. And then that management fee reduces your taxable income. So that's just a way you can essentially shift income outside of the US into a lower tax jurisdiction. And that's a lot easier with a corporation than LLC or partnership. And then partnerships, I usually don't recommend for international businesses or people outside of the US. The advantage is it's simple to attract investors and pull money for a profit. It's simple to set up and just have two people put their money together and start a business. In that regards, it's really easy. But the tax reporting is a lot more complex on a partnership than a corporation and an LLC usually. So that's kind of the lowdown of what entities are the best for your particular situation. So now I'll just get into how to set up a business entity in the US, just the stages you go through and how that works and what you need to do. So the first stage, you determine the determined stage. You figure out what type of entity you want, and that's usually based on investor requirements, how many people are involved, how much money you want to spend setting it up. And then you determine what state you want. And a lot of, like I said, LLCs are great. The states that are great for that are Nevada, Wyoming, New Mexico. Corporations, I'm sure most of you have heard, most people form corporations in the state of Delaware because it's a lot simpler than other states for, and they have laxer rules as far as who can invest. And so Delaware, if you're doing a corporation, Delaware is usually the state. I think in the US, I think over 60 or 70% of all corporations formed are formed in the state of Delaware. So that's usually the state we recommend. And then of course you have to have the name of the entity and register it with the state. So and once you do that, you actually go into the formation stage. And the first thing you have to do is you have to get a registered agent and or a formation services. Usually they're performed in conjunction with each other. And because of the rise in this popularity, there's a lot of online options you can choose, such as, I'm sure you've all heard of LegalZoom and Business. Tax Hub has a kind of a sister company, Embark, where we specifically form entities for non-US citizens because they, as you can see, have very specific tax law requirements. So you can check out those. Or another option, it's a lot more expensive. You can go to a local CPA or lawyer in the state that you want to form and just reach out to them and they can do it. Disadvantage is more expensive. So once you do that, you figure out your stock ownership if there's multiple owners involved. And as a corporation issues stock, LLCs and partnership just state the ownership percentage in the partnership agreements. And then you sign and execute the agreements, and then you file them with the Secretary of the State. If you're using a lawyer or an online service, they do all this for you. But if you're trying to do it on your own, you actually have to file with the Secretary of State. I think partnerships, there's a few states where you don't have to file, but every other state you have to file and register your name and the entity with the Secretary of State. And then once you do that, the next step, you get a employer identification number from the IRS. And this is pretty simple. You can just go online to irs.gov and there's a link on the homepage, get my EIN, and you give them all the information, the ownership information, the legal name and all that. And then they usually can send you an EIN that instantaneously once you go through the questionnaire. So that's pretty simple. And then the operation stage setting, after you set it up, there's obviously requirements that you have to fulfill annually to keep the entity in existence and operating. One thing you want to do is, and most people set up a foreign entity so they can have a US bank account, because you can't have a US business bank account without a US entity. So that's a lot of the foreigners who are setting up entities are doing it because they want to set up a bank account. And there's a couple of online banks that work great when you're not in the US, Mercury Bank or Wise. They're specifically set up for small business entities or startups. So you can check out those, just Google them, pretty easy to find. And then the next step, once you have the bank, you set up a merchant payment processor to collect payments. Stripe or PayPal usually works. PayPal can process transactions in different currencies. So that usually works with people who are working on or collecting revenues globally. That's a good processor. and then set up a bookkeeping system. I've done a seminar on that, or a webinar on that. There's a ton of online options. So you do that, you connect your bank account, and then you just code the transactions as they occur. So that's always important, because you'll need that for the recording, for the annual reporting requirements. And then when you have a separate legal entity, regardless of if it's a corporation, LLC, or partnership, you have to pay state franchise fees or renewal fees annually. They're usually anywhere from like $100 to, like I said, California is $800 every year. So I usually recommend not forming an LLC in California. That's the one state where it's just, there's a lot of red tape. So I would try and avoid that state if you're thinking about that. Then you report, if you have a change in ownership, you have to report that to the Secretary of State. And additionally, if you're a corporation, you have to report quarterly meetings to the Secretary of State. And then you have annual income tax reporting requirements with the IRS, and whatever state you formed in, you have to report income every year, regardless if there's activity or not. So if you form a corporation, you have to file a 1120. If you form a partnership, you file Form 1065. If you're an LLC, like I said earlier, you can choose your tax designation, because LLCs are disregarded entities. And usually LLCs choose corporation entities to be taxed as a corporation. And then they ship their profits to their home jurisdiction, or normally based on treaty, they don't have to pay taxes. So LLCs usually choose to be taxed as the 1120 corporation. And then this is the most important thing: when you have a LLC or corporation or partnership, you have to file a Form 5472. It's called information return of a 25% or more foreign-owned U.S. corporation. You file it along with the partnership to return 1065 or 1120. It's just a sub form of that that's attached to the tax return. And if you don't file this, the IRS takes it very seriously. It's a $25,000 penalty. So definitely keep cognizant of that, because they're very strict with that for some reason. But that's, I think, about all we have. If there's any questions, more than happy to entertain. Like I said, every scenario, because of the complexity and different vast amount of tax jurisdictions that US and the rest of the world is transacting with, it gets very specific and somewhat complex to your scenario. So, but happy to entertain any questions, or if you want, you can go one-on-one, go to taxhub.com and schedule a free 5-minute call. But Nicole, do we have any questions?
Yeah, thank you so much, George. This was super, super helpful. I know I thought of a few, but if anyone wants to go first, if anyone wants to throw it in the chat, George can read it, no problem. Anything specific, feel free. Okay, so I guess I could go first. This one is kind of like a nitty-gritty question, and I think it probably will depend, but if people want to set up a S corp or a partnership that's like a partnership for two people, but one of them is like a US citizen and another one is like a citizen of another country, how does this process work if like I know the form you just mentioned is like 25% foreign owned type of business?
Yeah. So it depends on how they're taxed. If there's a foreign owner, you can't be an S corp.
Okay.
So S corp's out of the question, but you can be taxed as a partnership. And usually the way that works is the domestic partner gets the income passed down to them, and they file that on, they claim that on their individual tax return and pay taxes on that. The foreign partner still gets the K1 that passes the income down to them, but they have to file, but they claim a tax treaty. Usually if there's a tax treaty between their home country and the US, they claim that they file and report that income, but claim that it's not taxable based on the tax treaty and the fact that they're not operating. They don't have the effectively connected income.
Okay, got it. Very interesting. Okay, cool. And then this one is more a lighthearted question, and I might have already asked you this. Can you explain a little bit the difference between, let's say, like someone is super new and they just do it old school and have all of their like expenses tracked in like Excel or like a Google sheet or something? How is that different than getting like a bookkeeping system?
Well, I mean, from a tax law perspective, it's not treated any different. It's just less organized. And if you get an audit, it's gonna be a lot harder to provide that documentation with, if you're just keeping track of your expenses on Excel or something. But even that, if you're a very small, just digital nomad that's a one-person operation, you can just do it on your own without a bookkeeping system. Just make sure you have access to your bank records to show that the transaction was actually paid. And then the IRS requirements that you have to keep continuous and contemporaneous records showing the business purpose. So you have to have some sort of log that says, all right, I went to like Office Max and spent $40 on supplies, and you just have to note that it was business supplies. So
as long as you're continually keeping track of it yourself, that's still okay, as long as you
that's
have.
still okay, and you're still in compliance with IRS requirements.
Okay, and then do you recommend taking like a screenshot of the transaction in like your banking app, or
well, no, you don't even, you just need the actual bank statement to show that it was the data that was paid, the amount that was paid, and then the written purpose of the expenditure. I got in on the previous webinar, I got into a lot more of this, but the only actual receipts you need to save are receipts for meals and entertainment. The IRS does specifically state that. But everything else, as long as you have a bank transaction and a written record showing the proof, then you're compliant with the IRS guidelines.
Okay, great. Okay, sounds great. Does anyone else have a question? Oh wait, we have one in the chat. Can you read it?
Let's see. I'm a US citizen. Let's say I start a business in Mexico. I make an S Corp in Nevada, but I ship all products from Mexico. So does that mean I won't pay any taxes on my business? Where would I pay taxes then? So you're a US citizen. If I start a business in Mexico, I assume that means you're living in Mexico and operating the business out of Mexico. So if that's the case, then you wouldn't pay taxes in the US. You would claim the tax treaty and the fact that there's no effectively connected income and you're not operating a trade or business within the US borders. So you would be responsible for tax in Mexico on that profit, but not in the US.
Cool. Any other questions?
I have a question.
Mhm.
This is Lorraine, by the way. So I'm planning on doing a year visa in New Zealand. Hopefully this year, I believe it will be. But should I, like right now, I'm a sole proprietor. Should I plan on getting an LLC here in the US before going over for a year? Or does it not really matter?
what's your sources of income? How are you gonna be earning income when you're in New Zealand?
I do writing and photography, but I think I probably won't be making much money photography wise. It'll mostly be just the blog writing and copywriting that I'm doing now.
Are you getting clients that are in the US and paying you in US dollars just to a US bank account, or how does that work?
Yeah, I'm kind of transitioning, so I'm trying to get my own independent clients off of any freelancing platform. So those clients are usually in the US, but anybody on like a Fiverr platform, they could be from anywhere.
Yeah. So yeah, generally you won't be subject to US taxation. You'll have to pay tax in your home country. And there's two layers of protection you have there against taxation in the US. One, there's the fact that you don't have any effectively connected income in the US, so that there's no taxing jurisdiction. And the second, there's a foreign earned income exclusion that is up to, I think, about $110,000, 108. So any income a US citizen earns abroad is sheltered up to that $108,000. That's for income taxes. If you have, that doesn't apply to self-employment tax, so you still would be subject to that 15% self-employment tax, but for income tax, you wouldn't have to pay any taxes. And that's where you can, if your income's in the higher, over like anywhere from like 70 to and beyond, that's where you could benefit from forming an S corp. So you might want to look at that. We've done a couple webinars on that as well. So
Right. So I don't necessarily need to get an LLC before leaving the US.
no, you don't. Yeah. I mean, if you want to talk to me after and you can tell me exactly like how much income you're planning on making, I can kind of tailor what exactly you would need to do, but generally you wouldn't.
Okay.
Yeah.
And then also an update in the chat question. If someone's like a digital nomad, but living in Mexico in the moment, but his products are from Mexico, does that have any effect on your previous answer?
So it depends. So is he living in the US or living somewhere else besides Mexico? Like say you go to Ecuador or something. If that's the case, it doesn't change the tax law. You still don't have effectively connected income. So you wouldn't be subject to US taxes. Are you a US? Yeah, you're a US citizen, but then you fall into the problem of self-employment taxes, and that's where you can benefit from the S corp. So for tax purposes, no, you wouldn't, but potentially for self-employment, you would be subject to that.
Yeah, and those are much larger than I ever thought. So
yeah,
true.
Definitely. Unfortunately for people like you, Nicole, I know you're a digital nomad who got hit with a pretty bad surprise. Yeah. Unfortunately, wish we would have talked about a year ago and we could have helped you with that, but going forward, we're good. So yeah. Anything else?
Any other questions? Feel free. If not, then I think we could wrap up and I'll end the recording. But again, thank you so much, George. This is super helpful. We'll be uploading this link to YouTube and then posting the recap later in the Numina app. But yeah, thank you again so much. I hope everyone has an amazing day. Thank you.
All right. Yeah, awesome. Hopefully I helped. Yep. Take care.
Bye.